Welcome to the deep dive on the Japan Stock Podcast. I am the lead analyst here. And if you still think of Panasonic as just the microwave humming in your kitchen or, the family TV you grew up watching, you are completely missing the real story.
Oh, absolutely. I am the market strategist, and I can tell you that is such an outdated view.
Yeah.
I mean, today we are going to look at how they are literally the engine room powering the global AI and electric vehicle revolutions.
Right. So today's mission is to really dissect this radical transformation. We want to figure out if this two-century-old legacy giant has actually rewired its corporate DNA to be a hidden gem for the next 3 years, or if the market is just being fooled by a temporary tailwind.
And it is a high-stakes, real-time drama. To understand this company right now, you really have to throw out all your preconceived notions of consumer electronics. I mean, the 80-20 rule is in full effect here.
Yeah, the consumer gadgets might give them brand recognition, but the core profit drivers, the actual financial engines of this entire conglomerate, are firmly entrenched in highly specialized B2B infrastructure.
Specifically, there are two massive segments driving the bus. First is the energy segment, which, encompasses their automotive EV cells and their industrial battery backup units, or BBUs.
Right, the BBUs are huge right now. And second is the Connect segment. That houses complex aviation electronics and their Blue Yonder supply chain management software.
Think of them like an actor who got typecast as the family-friendly sitcom star, home appliances, but they've secretly spent the last decade in the gym. Now they aren't the TV in your living room anymore.
I love that analogy. They are the heavyweight lifters for the tech boom. But, the journey to becoming a B2B infrastructure giant was anything but smooth. I mean, they carry massive, deep corporate scars from the past decade.
Yeah, we are talking about catastrophic capital destruction during their plasma TV and semiconductor eras.
Exactly. Back then, they operated on just supreme hubris. They had this build it and they will come mentality, pouring billions into massive production facilities.
Assuming that their vertical integration would just naturally dominate the market, like they wanted to make every single component from the glass to the circuitry in-house.
Right. But they built all that capacity without actually securing the buyers first. And when cheaper competitors completely undercut them, they were left holding these multi-billion-dollar zombie factories.
Which is devastating. And honestly, those scars directly explain the intense culture shock the company is undergoing today. Management finally realized that the plasma disaster wasn't just a product failure, it was a systemic cultural failure.
Historically, this was a very traditional top-down Japanese conglomerate, right? Where the unspoken rule was to blindly follow the president.
Yeah, middle managers would hide bad data or completely ignore market signals because, well, challenging the prevailing internal narrative was basically career suicide.
Which is exactly why CEO Yuki Kusumi had to essentially declare war on his own company's operating system. To shatter that deference to authority, he brought in a complete outsider, Tatsuo Kinoshita, as the chief human resources officer.
And the weapon Kinoshita deployed wasn't just a motivational speech. It was ruthless financial mathematics. They implemented a strict, uncompromising hurdle rate across the entire company, WACC plus 3%.
Let's break down the mechanics of that, because it is vital for any investor looking at this stock. WACC is the weighted average cost of capital, essentially what it costs the company to borrow money and satisfy its shareholders.
Right. So by mandating a return on invested capital that beats that cost by 3 full percentage points, management just removed all the emotion from the equation.
Exactly. If a legacy business unit costs 5% to fund, but only generates a 6% return, it's failing the hurdle rate. It doesn't matter if it's a beloved heritage brand.
The mandate is brutal. You either cut your internal costs drastically to hit the margin you find a buyer, or you are liquidated.
I have to push back a bit, though. A mandate on a spreadsheet is one thing, but actually turning around a 250-year-old corporate culture is notoriously difficult.
Oh, for sure. It's like turning a supertanker with a paddle.
Exactly. So is this financial discipline actually translating into market share, or are they just shrinking the company to profitability?
That is the right question, because shrinking to profitability only buys you time. To see the actual growth, we have to look at the virtual battle they are fighting in the competitive landscape right now.
Right. They are caught in a massive pincer movement. On one side, you have the pure-play EV battery makers racing to scale up.
And on the other side, you have traditional, hyper-aggressive consumer appliance rivals.
Yeah. And instead of fighting a war of attrition in the red ocean of basic component assembly or, getting dragged into brutal consumer pricing wars, they chose a completely different route. Let's call it Path A.
Which is ruthlessly pivoting toward complex material processing technology and highly specialized defensive B2B ecosystems.
They realized they simply cannot out-assemble the cheapest global competitors, so they are out-engineering them in areas where the switching costs are incredibly high.
And that strategic pivot leads us directly to their absolute strongest economic moat. Right now, their generative AI data center battery backup units, the BBUs.
When most people hear battery backup, they think of the little uninterruptible power supply sitting under their home desk, right? The thing that keeps your PC on for 5 minutes during a storm.
Right, but the reality of AI infrastructure is a completely different universe. I mean, the GPUs driving the entire generative AI boom, like those massive server racks inside global data centers, they do not draw power in a smooth, predictable curve.
Not at all. When those chips process immense, complex, large language models, their power consumption surges instantaneously. We are talking about microsecond spikes of megawatt demand.
Exactly, and a standard municipal power grid simply cannot handle that instantaneous volatility.
No, if a data center pulls a massive spike directly from the local grid, breakers trip, transformers blow, and a multi-billion-dollar facility just goes dark.
So this company's BBUs act as the critical buffer. They slowly and steadily absorb power from the grid and then instantaneously discharge it into the GPUs to clip those massive demand peaks.
It's a highly specialized peak cut technology. They are literally selling the fail-safe insurance policy that stops the AI revolution from melting down the local power grid.
And because the cost of failure is so catastrophic for data center operators, these BBUs command incredibly high margins. The contracts are incredibly sticky.
The technological moat places them right at the center of the global tech infrastructure boom. But supplying mission-critical power management systems to United States data centers makes them highly exposed to geopolitical friction.
Oh, absolutely. The North American market is the prize, but it is covered in regulatory tripwires.
We need to dissect the massive global ifs surrounding this strategy, starting with that U.S. exposure. In October 2025, they signed a memorandum of understanding for a massive $15 billion U.S. investment framework.
On paper, that secures their capacity to feed the U.S. data center boom. But practically, it exposes them directly to trade policy volatility, particularly the Trump effect.
The core of that risk centers entirely on the Inflation Reduction Act, specifically the 45X Advanced Manufacturing Production Tax Credits.
Right. Those credits fundamentally alter the unit economics of battery production by heavily subsidizing the cost per kilowatt hour manufactured on U.S. soil.
So if the U.S. political winds shift and those subsidies are repealed or, significantly watered down, does that $15 billion framework suddenly transform from a strategic masterstroke into a massive liability?
It absolutely would if they were repeating the mistakes of their plasma TV days and just blindly pouring concrete for mega factories in the Midwest.
But those past scars have served as armor here. Instead of diving headfirst into massive U.S. greenfield projects, they pivoted to a highly calculated local-for-local strategy.
Yeah, in February 2026, they announced a major expansion of their BBU module factory down in Mexico.
Which is a brilliant structural bypass. By expanding a facility in Mexico, they leverage the USMCA trade protections to supply the North American data center market tariff-free.
And at the same time, they insulate themselves from the specific legislative risks of the IRA. They avoid the volatility of U.S. labor union disputes, and they completely sidestep the environmental permitting nightmares that delay U.S. greenfield projects by years.
It is incredibly smart. But securing the North American BBU market doesn't solve their problems across the Pacific. I want to look at the elephant in the room, China.
Yeah, this is where it gets tricky.
Wait, isn't that a bit optimistic given the intense pricing pressure over there? How on earth are they surviving the onslaught from Chinese domestic competitors who are notorious for exporting deflation and crushing foreign brands on price?
Their survival in China might actually be the most counterintuitive part of their entire turnaround. Historically, Japanese companies try to micromanage their overseas operations from Tokyo, but management realized that strategy was fatal in a market moving as fast as China. So they did something unprecedented for a legacy conglomerate. They completely cut the cord.
They isolated their China appliance business and granted the local Chinese management team total operational autonomy.
Exactly. By severing that reporting line, the Chinese team bypassed months of bureaucratic approval processes. They didn't have to wait for an engineering sign-off from Japan just to source a cheaper local component.
They could iterate designs and adjust supply chains in weeks instead of years. They essentially used the most cutthroat consumer market on Earth as a hypergravity training room, right? Achieving extreme cost competitiveness while still maintaining high-end Japanese engineering standards.
But wait, the story doesn't end there. Winning in China is great for the regional balance sheet, but they are now executing a fascinating reverse import strategy.
Oh, the reverse importing.
Yeah, they are taking products developed in that hyper-competitive environment, like ultra-premium, $5,000 smart washing machines, and reverse importing them back into Japan and the rest of Asia.
Let me stop you right there. Selling a $5,000 appliance in Japan sounds great on a slide deck, but Japanese consumers are notoriously loyal to domestic manufacturing. Are they actually buying these Chinese-made premium appliances? Or is management just spinning a narrative to cover up excess inventory?
No, they are actually buying them, and the reason comes down to the margins. Because the base manufacturing and component sourcing are tied to that ruthless Chinese cost structure, the company can pack those machines with advanced software, sensors, and premium finishes that domestic Japanese rivals simply cannot match at the same price point.
So they're fighting off Chinese competitors on their home turf using the very weapons forged in the Chinese market.
Exactly. That operational efficiency is critical, especially when you factor in the macro environment. We have seen the yen strengthen significantly, shifting from 150 down to 140 against the dollar.
Right. And when a company makes money overseas, in dollars or yuan, a weak yen naturally inflates their reported earnings back in Tokyo. When the yen strengthens to 140, that paper profit just evaporates.
The underlying business has to actually be efficient because you can no longer hide behind favorable currency translation.
So if we pull all these threads together, the WACC plus 3% hurdle rate, the AI battery backups, the Mexican supply chain pivot, how does it actually translate to the stock price and EPS?
Because for years, the market treated this company like a dinosaur.
Right. But the engine room numbers from late 2025 and early 2026 tell the story of a massive revaluation. For a long time, this company suffered from a dismal price-to-book ratio. In mid-2024, it was sitting at a painful 0.7x.
For context, anything below 1.0x means the broader market believes the company's assets would theoretically be worth more if the business was just liquidated and sold for parts.
Exactly. It's an insult to management. But by March 2026, they officially pushed that PVR over the 1.0x threshold.
Which is a massive psychological and financial milestone for a legacy Japanese firm. It means the market finally believes management is creating value, not destroying it. How did they force that shift?
It was a brutal, calculated combination of events. In FY 2025, they executed aggressive structural reforms, which included massive headcount reductions, severance payouts, and fixed cost slashing across their underperforming legacy segments.
And initially, that hurt the bottom line.
Yeah, but when the unexpected, explosive boom in AI BBU demand hit in FY 2026, they possessed an incredibly lean operational structure.
They had this massive tailwind of high-margin B2B revenue flowing into a company that had just aggressively slashed its overhead.
That operational leverage is why they are now projecting an adjusted operating profit of over 600 billion yen for FY 2026.
Which proves the turnaround is mathematically real. They finally stopped bleeding cash on zombie projects. But, generating cash is one thing. How management allocates that capital moving forward will define the next decade.
And frankly, this is where a lot of retail investors get nervous. In May 2026, management announced a 500 billion yen investment targeted mostly at AI infrastructure and battery capacity.
If you are looking at that 500 billion yen headline, you are probably having flashbacks to the plasma TV disaster. You have to wonder, are they actually returning value to shareholders? Or are they just empire building again, but this time slapping AI on the press release?
Right. Are we looking at disciplined capital allocation or a management team that just got a windfall and is looking for an excuse to pour more concrete?
Exactly.
The truth is really in the nature of the cash deployment. Because of those historical scars, management is exercising extreme discipline. They are not taking that 500 billion yen and building speculative greenfield megafactories from scratch.
Because a greenfield project means starting with a patch of dirt. You take on all the permitting risk, construction delays, and a massive upfront capital drain.
Exactly. Instead, they are directing that capital almost entirely into brownfield expansions, specifically scaling up that existing Mexico facility we discussed.
The factory walls are already up, the logistics routes are established.
Right. They are simply adding specialized production lines to hit a highly targeted 800 billion yen BBU sales goal by 2028.
That substantially lowers the execution risk. But we also have to acknowledge that aggressive growth always demands a trade-off.
It does. And to their credit, management did not hide the ball. In March 2026, they explicitly admitted that financing this necessary AI capacity expansion might constrain their ability to execute massive immediate share buybacks.
They made a deliberate strategic choice.
Yeah.
If they don't capture the data center BBU land grab right now, competitors will lock in those sticky contracts for the next decade.
So they opted to balance long-term, high-margin market dominance with steady, albeit slightly restrained, shareholder returns.
Okay, we have outlined the AI battery boom, the disciplined capital allocation, and the structural turnaround. But as a professional analyst, you cannot just look at the victories. We have to take the rose-colored glasses off.
Always.
Where is the major risk factor right now? Where is the blind spot that could derail this entire 600 billion yen profit projection?
The absolute biggest vulnerability, the anchor that could drag the ROE down, is sitting right in the middle of their Connect segment. Specifically, the Blue Yonder supply chain management software acquisition. This is the area every prudent investor must stress test over the next 4 quarters.
The premise of acquiring Blue Yonder made sense. They wanted to move beyond just selling hardware and actually own the software layer that manages global logistics.
But integrating a massive software company is a completely different beast than optimizing a manufacturing line.
Oh, completely.
They are carrying heavy goodwill on the balance sheet from the premium they paid for that acquisition, and frankly, the revenue growth has been frustratingly slow. Now, management defends this by claiming they've spent the last few years completely rebuilding the software architecture.
Right, transitioning it from legacy code into a native SaaS cognitive solution driven by AI. They are aggressively targeting the Rule of 40.
Yes, the Rule of 40 being the golden metric for software companies, where your revenue growth rate plus your profit margin equals 40% or more.
If you hit that, it proves to the market that you can scale rapidly while remaining highly profitable, which is the baseline requirement for a successful IPO.
But getting Blue Yonder to that metric involves a terrifyingly complex sales process. Selling enterprise supply chain software isn't like selling a battery module to a data center.
No, it's not.
It is, it's like trying to perform a central nervous system transplant on a multinational corporation while the patient is awake.
Oh, wow. Yeah, and running a marathon at the same time.
Exactly. You are asking a global logistics company to rip out their deeply entrenched legacy IT infrastructure, their SAP or Oracle systems, and trust Blue Yonder with their entire operational nervous system.
The risk of paralysis is so high that the end-to-end sales cycle takes quarters, sometimes years, just to get a signature.
Precisely. And while management waits for these complex multi-million-dollar deals to close, that software division is burning through capital. The risk is that if Blue Yonder fails to achieve that Rule of 40, an IPO becomes impossible, and it turns into a massive capital sinkhole.
Which would artificially depress the incredible margins being generated by the BBU division.
Exactly.
So we are looking at a company that has successfully utilized brutal financial discipline to trim its bloated legacy operations. It has weaponized its Chinese supply chain to fight off deflation and positioned itself as the critical failsafe for the global AI revolution.
Yet it is still balancing heavy infrastructure investments and struggling to fully digest a massive software acquisition.
Which leaves us with the ultimate question.
The single variable you have to underwrite if you are considering this stock for the next 3 years.
Yeah.
Can a 2-century-old hardware manufacturer truly finalize the rewiring of its corporate DNA to become an agile AI infrastructure and software provider? And can they solidify that dominance before the global energy and EV markets fully commoditize?
That is the ultimate test of whether an old giant can not only learn new tricks, but actively invent them. Thank you for joining us on this deep dive on the Japan Stock Podcast. Keep questioning the consensus, keep digging into the engine room numbers, and we'll see you next time.